Hello, good afternoon, and welcome to the weekly roundup for the week ending Friday, the 25th of June. Hope that you're continuing to enjoy the weekly reports. Again, remember to subscribe below, and any questions, pop them in the comment box. Always happy to hear from you. Also, as well, any specific reports, again, let us know, especially on the IPO front. Right, this week, stock markets have really crept their way up on both sides of the Atlantic. Here in the UK, the main focus has been on the Bank of England. Policymakers remained upbeat about the UK economic recovery. However, as with the Fed, they expect above target inflation to be transitory. The central bank made no changes to policy and gave no hints as to when policy could be tightened. The Bank of England's accommodative policy, in addition to rising oil and commodity prices, have helped the FTSE gain this week, up 1.4%, and the DAX has gained 0.8%. In the US, Fed speakers have been dominating the airwaves after the Federal Reserve's surprise hawkish turn last week. Fed Chair Powell reassured the market that the Fed won't move too soon to hike rates, which helped boost sentiment. And Biden's $600 billion bipartisan infrastructure deal has also lifted demand for stocks, sending the S&P 500 to a fresh all-time high. S&P 500 and the Nasdaq both gained 2.4% this week. Dow Jones up 2.7% over the week. Over in the FX markets, US dollar set for a weekly loss after 4 straight weeks of gains. So again, the Fed's Powell's calming words, in addition to marginally weaker data, has dragged on the US dollar. The euro against the dollar set for gains of around 0.6% thanks to strong PMI data and rebounding business and consumer confidence. Pound against the dollar set to gain 0.7% versus the US dollar this week, despite the Bank of England's lack of any action. Over in the commodities market, we've seen the oil price on the rise, third straight session, and are on track to book gains of 2.5% across the week. This will mark oil's 5th straight week of gains. Both oil benchmarks hit the highest level since 2018 this week, with economies reopening and fuel demand picking up. The demand outlook is strong. Demand at this point is certainly outstripping supply. Inventories have fallen sharply again this week. Gold trading a very tight range at the moment, within that familiar sort of sub $1,800 level after tumbling 6% in the previous week. Mixed messages from the Fed really over interest rate expectations. Has certainly been a contributing factor to the choppy trading seen in the precious metal. Over in the sort of stocks, notable moves. Travel stocks have been very much in focus this week again as the UK government's widened its travel green list. However, rather than gaining across the week, these stocks have actually dropped. This is because several European countries are insisting that British tourists must quarantine on arrival, given the spread of the Delta variant. So a move which could harm the key summer season and the key summer destinations. So we've actually got IAG trading down 4.5% lower this week. On the flip side, you've got BP. With the oil price surging, oil majors have been tearing higher. So BP's up 4% over the week. Over in the US, notable movers, really, Nike, or Nike, depending how you pronounce it. I'm a Nike man myself. But they're set to gain 16% across the week after reporting a blowout on earnings. In its fiscal fourth quarter, earnings per share came in at 93 cents a share versus 51 cents forecast. And that's on revenue of $12.34 billion over the 1 billion, or over, should I say, 1 billion more than the 11 billion forecast as well. So the feed across from these stellar numbers has been impressive, with Adidas up 5%. JD Sports took a big move off the back of it as well. So thank you very much for watching. Please remember to subscribe. Any questions you've got, ask. And don't forget to head over to the app stores. Find out the Atlantic Capital Markets app. Real good members area. Like I said, for those of you that have got more than a passing interest in the markets. Take care. Thank you.